PPI surprising to the downside, coming in at 6.4%, consensus 6.8. Where did you think it was going to head?
Well, I was sort of on the 6.8. I was actually thinking it might even go up a little bit to 6.9 or so. But nonetheless, I think the bigger picture here is that we've had our second big fall in the PPI, more than expected. That's actually a little bit of good news. The fact of the matter is the CPI, however, is now turning up because the PPI turned up many months ago. So I think at this moment in time, the combined story tells me that interest rates on the short end of the market are not going to go anywhere soon. They're not going to decrease. They're probably not going to increase well into next year. Somewhere in the second half, we may start seeing changes in interest rates.
Do you think we could see CPI then trending back down again towards that 3% target if, as you suggest, it is following PPI a little bit?
Well, PPI is probably 2 or 3 months ahead of the trend, but I think with the PPI having risen so much for so many months from where it was negative about, I don't know, 18 months, 2 years ago, to where it is where it turned at just under 10%, I think we've got to take a view that CPI is probably going to trend upwards, but slowly upwards for the next 6 to 8 months. I think that's the way I would see it before it starts looking perhaps for a different direction. But I think the PPI is not a direct relationship with the CPI anymore. It reflects some of the goods, but the main thing in the CPI now at the moment, I think, that we have to look at is the services component. And that's certainly going to be under pressure in both the PPI and the CPI from things like electricity prices and the like.
It's interesting because we have cited those as being an issue, you know, the administrative costs, and you know, when is that going to start filtering through into the CPI now? Because that actually hasn't started to reflect it, though.
It is filtered through, but I think there's one thing that we must remember is that if you did this on a chain-weighted basis, you would have a very different number for your consumer price and your because the electricity costs have gone up quite tremendously, and as a percentage, say, of our total spending in the economy, we've seen, for example, local government revenues come from about a 6% a few years ago to nearly a 9% now. So it's certainly picked up quite a lot, whereas our CPI keeps on saying, but it's just under 2%, it's just under 2%, when in fact most of us are spending a lot more on electricity and a lot more on water, and that's actually having an impact on the economy that people don't always think about, because it's similar to a rate hike.
Doesn't that perhaps mean that we'll spend less elsewhere?
Yes.
And then essentially...
Absolutely, that's where you're right, and that's what I'm saying. It's similar to a rate hike, and it affects more people. If you think of South Africa, every quarter, less than 40,000 people buy a house or take out a mortgage. That's what the NCR figures tell us. And then over time, they pay it off. And most South Africans seem to pay their houses off within about 10 years. So essentially, we're looking at roughly 1.6 million households having some form of mortgage bond out there. But there's approximately 9 million formal houses in South Africa at the moment, or over 10.4, of which we think about 9 million have services that they should be paying for. Not all of them we know are paying, but that means that let's make it 6 million that are paying. 6 million households have had a huge increase in electricity and water bills over the last 3 or 4 years, and that's taken away a lot of the good effects of interest rate cuts, whereas at the same time those interest rate cuts has meant that the savers in the economy, the older people that need to survive with that money to pay off the electricity, are having a much harder time.
To what extent do you think the rand strength over the past year is also masking some of the underlying inflation threats in the economy?
Well, absolutely. I think the rand strength is playing a very big role. I think most economists tend to get currencies wrong, and I'm one of them. I get currencies wrong all the time. And certainly I thought inflation was going to be a lot higher this year. But I think with the rand strength, if you look at that, that certainly wiped out a large part of the electricity hikes and all those type of things. Where we've seen increases has come from things like tax hikes on the cars last month, the administrative prices that we've just spoken about, so on. But I don't know how long the rand can keep on strengthening. So just a flattening out of the rand and then say slight weakening of the rand may change the inflation picture for both the PPI and the CPI.
Well, some would say that, you know, the rand can continue its strength as long as there's going to be hot money, and it seems that with the new round of quantitative easing there will be hot money flowing into emerging markets. Our yield is far better than that of the developed world, so it's a strong argument for a much higher rand.
Yes, it is, but there is one other aspect of this whole thing, is eventually how much money can we absorb? Because it's very clear that, for example, we spoke about a lake some time ago, that this US dollar, that's a big lake, and it's filling up this little bath next door to it. Now, this little bath is already getting quite full because about 31% of our equity markets are now foreign owned. Roughly about 12% of our bond market, we think, is foreign owned, but the institutions also have a capacity and they need to take on a lot of that. Then of our banking market, very little is still foreign owned because people don't really want to move into our banking market. There's, say, about 5%. But that means overall in the economy, about 14–15% of our economy is foreign owned today. And it can only go up to a certain point because South Africans are still struggling to find their way out of the country. Yes, we are relaxing exchange controls, but there will be pressure for us to have some of our own ownership, and you would probably prefer that. So there's only so much that the foreigners can throw even their hot money in here. So I think at some stage, we don't know perhaps when, but that momentum of buying up rand assets, especially the liquid assets, has to run out. Because certainly at 31%, I think the max you can probably go to foreign ownership is probably 50% or so, because just your pension funds are going to have to keep a heck of a lot of money in the country. So it limits foreign ownership to a certain extent. And I'm not sure how the bond market or the money markets will, but essentially at some stage that runs out. And I think we've seen most of the rand strength. I might be wrong, but I think in the longer term, I'm probably more right than wrong on that one, because the hot money, I think, is going to have to look for other markets as well. The bath is starting to run over. That's the scenario. So we've got a lot of from the lakes waters come in, but the bath is so small that it's starting to run over, and our money has to flow somewhere else. And that's why I think the end of the rand strength, or strengthening rand all the time, is probably closer than we think.